As of Monday, April 6, 2026, President Donald Trump says the Tuesday, April 7, 2026, 8:00 p.m. Eastern deadline for Iran remains in place. According to current reports, the deadline is tied to a proposed deal that would require Iran to reopen the Strait of Hormuz. Iran has rejected the proposal and has threatened retaliation if the United States escalates further. And yet, when Asian markets opened, the big financial headline was not the growing crisis in the Persian Gulf. It was silver falling towards $72 per troy ounce for the third straight session. And the explanation you were given sounded familiar. Silver was weak because of hawkish Federal Reserve expectations, rising energy prices, and what mainstream outlets called fading safe haven demand. But before I go one step further, let me ask you something. Where are you watching from right now? What city? What country? What time zone? Because the version of this story you are getting depends on where you are. Which exchange opens first in your region? Which central bank speaks during your day? And which institution is supposedly holding the metal your screen says you own? This is Bridgeport Finance Channel. No talking points from asset managers while their traders quietly position the other way. No sponsors whose compliance team approves the message only after the trade is already placed. Just filings, just vault reports, just public data. And somehow, that data almost never appears in the same sentence as the price chart on your screen. If you are new here, do us a favor by subscribing to Bridgeport Finance Channel now. Because by the time this reaches a mainstream afternoon segment, the positions will already be set and the profit will likely belong to someone else. Now let us start with the official narrative. Silver was said to be holding losses for the third straight day, trading around $72.20 per ounce during Asian hours. The reason, we were told, was simple. Energy prices were rising. That pushed inflation worries higher. Central banks were expected to stay hawkish, meaning they would keep interest rates high or even raise them further. Silver pays no yield, so in that kind of environment it becomes less attractive. Investors sell. Forced liquidations hit the market. Silver falls. Clean story. Simple story. Repeatable story. And that is exactly why it gets repeated almost word for word across Reuters, Bloomberg, FX Street, Kitco, and many other outlets. But here is the problem. That story leaves out the most important part. As of the end of March 2026, COMEX registered silver inventory stood at roughly 76.4 million ounces. That was down more than 11.6 million ounces in just 30 days. It was down 64% from the April 2020 peak of 240 million ounces. Coverage against outstanding paper claims had fallen to around 13.2%, which sits deep inside what commodity analysts would call stress territory. The paper leverage ratio, meaning the number of claims on each ounce of physical silver, stood at 7.6 to 1. And if withdrawals continue at the current pace, the depletion clock points to roughly 145 trading days before registered inventory reaches levels that could seriously threaten the exchange's ability to settle contracts with physical metal. That is not my opinion. That is published data. It is public. It is verifiable. It is there for anyone to read. So when you hear that silver is falling because of forced liquidations and weak safe haven demand, ask yourself this. Why is the physical metal leaving the warehouse at a pace the exchange has never seen in modern history? That question almost never gets asked. Now let me take this one step further. In the fourth quarter of 2025, Jane Street Capital held roughly 41,000 shares of the iShares Silver Trust, ticker SLV. By the end of that same quarter, the position had exploded to about 20.66 million shares. That is a 500-fold increase in just 90 days. That move made Jane Street the largest reported holder of the world's biggest physically backed silver ETF, even ahead of BlackRock, the sponsor of the fund itself. At the same time, Morgan Stanley reduced its SLV position by 3.7 million shares. BlackRock added nothing. But Jane Street, a trading firm heavily tied to options and derivatives, made one of the most aggressive silver moves on record. And remember, the custodian holding the physical metal for SLV is JP Morgan Chase. The same bank that in 2020 paid $920.2 million to settle federal charges tied to spoofing and manipulation in precious metals futures over an 8-year period. No new allegations are being made here. No fresh investigation has been announced. But the structural question still matters. What does it mean when the largest volatility-focused trading firm in the world takes a historic position in a physically backed silver ETF while the price is falling, while other major institutions are reducing exposure or standing still, and while the custodian sits inside a market with a known history of manipulation? It means someone has a view. It means someone believes the current price does not reflect the future price. It means this is not just a hedge. It looks like a bet, and firms that sophisticated do not place bets of that size based on random guesses. They do it because they see something in the structure, in the timing, or in the catalyst path that the broader market has not fully priced. Now add India to the picture. On April 1st, 2026, the Reserve Bank of India enacted a directive across its regulated banking system. As of that date, silver became legally eligible as loan collateral at a 10-to-1 ratio against gold. In simple terms, households can now pledge physical silver jewelry or coins and borrow against them without selling them. 10 kilograms of silver can support a loan with an 85% loan-to-value ratio up to 2.5 lakh rupees, or around $3,000. Gold requires only 1 kilogram for the same facility. This is not a trial. This is not a draft proposal. This is active policy. And it matters because India already ranks among the largest silver-consuming nations in the world. More important, the policy draws a legal line between physical silver and paper silver. ETFs, mutual funds, and bullion bars were excluded. The banking system gave value to physical silver only. That means existing household silver can now be monetized without being sold into the market. Read that again. This policy does not just create demand. It can lock supply away. Analysts estimate that over the next 12 to 24 months, as many as 250 million Indians could access this facility. Even if only 10% use it, tens of millions of ounces could quietly move into a collateral system and out of the sale channel. No big headline, no dramatic warning, no Western exchange report showing it clearly, just supply disappearing quietly in the background. And since this policy went live, silver has fallen more than 8%. Does that make sense to you? If it does not, good. You are asking the right question. Now let us go to China. On January 1st, 2026, Beijing formally added silver to its list of dual-use strategic materials requiring state-issued export licenses. Only 44 companies were approved. New applicants must show annual refining capacity of at least 80 tons and credit facilities above $30 million. This is the same kind of control structure China used with gallium and germanium, where the state effectively controls exports through licensing. China refined and exported more than 4,000 tons of silver in the first 11 months of 2025. Now that metal sits behind a state-controlled wall that can restrict outbound flow whenever Beijing chooses. At the same time, China increased imports. Chinese customs data showed more than 790 tons of silver imported in the first 2 months of 2026. February alone accounted for nearly 470 tons, the highest February figure on record. Meanwhile, Hong Kong spot premiums on large silver bars reportedly rose as high as $8 above the London benchmark. That kind of premium should not exist if physical metal is truly available at the quoted screen price. Then look at Shanghai. Inventories on the Shanghai Gold Exchange and Shanghai Futures Exchange have fallen by roughly 193 million ounces from their 2020 peak. And from November 2025 to February 2026 alone, Shanghai inventories dropped from about 559 tons to 318.5 tons. That is a 43% decline in 1 quarter. So let us be clear. The world's largest silver consumer and largest refiner is restricting exports, increasing imports, and draining exchange inventories, all while paper prices in New York and London are falling. That is not a normal signal. Now bring the geopolitical piece back into focus. On April 7th, 2026 at 8:10 p.m. Eastern, President Donald Trump's deadline for Iran to reopen the Strait of Hormuz passed without compliance. Trump had publicly threatened severe retaliation, including strikes on critical infrastructure. Iran rejected the ultimatum. Energy infrastructure attacks across the Middle East continued. Brent crude moved above $100 per barrel. WTI moved above $96. The world's most important energy choke point remained closed. And the mainstream explanation for silver was still this: higher oil means higher inflation. Higher inflation means central banks stay hawkish. Higher rates or no cuts means silver becomes less attractive. Therefore, silver falls. That logic sounds reasonable. But it only works if you ignore the rest of the equation. The Federal Reserve's policy rate is around 4.25 to 4.5%. Core PCE inflation is around 3.1%. That gives you a real rate, meaning the rate after inflation, of roughly 1.2%. But if oil stays above $100 for 60 days or more, inflation models suggest core PCE could move toward 3.5% or higher by the third quarter. Now, the Fed has a problem. It cannot cut rates into rising inflation without making inflation worse. It also cannot easily raise rates without crushing a labor market that is already weakening, worsening commercial real estate stress, and increasing debt service pressure on a U.S. government already paying more than $1 trillion a year to service debt. So what is left? Hold rates, talk tough, wait. But if inflation runs above policy rates, real interest rates are not rising. They are falling. And falling real rates have historically been one of the most bullish environments for precious metals. This is not theory. This is history. Silver's biggest moves over the last 50 years came when nominal rates looked high, but real rates were weak or negative because inflation was hotter. That happened in 1979 to 1980. It happened in 2010 to 2011. And this argument says it may be happening again in 2025 to 2026. Look at the Bank of England. It held rates at 3.75% in March and paused easing because of inflation risk tied to energy prices. Look at the European Central Bank. Officials have kept repeating that policy must remain restrictive until inflation is clearly back at 2%. Translation: no easy cuts, possible tightening bias, and no real room to restart balance sheet expansion without reigniting inflation. So when the media says hawkish central banks are bearish for silver, what they are not fully explaining is this: in a stagflationary environment where growth is weak but inflation stays high, hawkish central banks can actually help create the exact setup in which gold and silver surge. Now let us deal with the argument being pushed hardest of all: forced liquidations. We are told silver is falling because investors are being forced to sell precious metals to cover losses elsewhere. That sounds reasonable until you ask one simple follow-up question. If forced liquidations are driving the move, why is physical silver leaving the warehouse at record speed? Forced liquidations happen in futures. They happen in options. They happen in paper. They do not explain 33.45 million ounces of physical silver being withdrawn from COMEX registered vaults in a single week, which reportedly happened in early January. They do not explain Shanghai inventories falling 43% in 3 months. They do not explain $8 premiums in Hong Kong. What this looks like is paper selling and physical buying happening at the same time by different players. The seller is the leveraged trader who bought high using borrowed money and got crushed by a margin increase. The buyer is the player who is not using leverage, does not care about the daily noise, and is positioning for where the market may be in 6, 12, or 18 months. That is the deeper divide. Not everyone in this market is playing the same game. The original argument points to Jane Street with 20.66 million shares of SLV. It points to Sprott doubling its at-the-market equity program to $2 billion, giving it the firepower to buy large amounts of physical silver. It points to institutional buyers in Shanghai paying huge premiums while the screen tells you there is no shortage. Now let me show you the playbook, because this has happened before. On January 30th, 2026, silver hit an intraday peak above $121 per ounce. That same day, CME Group raised margin requirements on COMEX silver futures. The initial bond moved from $22,000 per contract to $25,000, a 14% increase. Then 1 week later, margins were raised again. In about 40 days, the cost of holding a leveraged silver long position rose by nearly 2/3. Then came the collapse. On February 2nd, silver reportedly fell 27% in a single session. Over the next few weeks, the price plunged from $121 to around $70, and yet physical fundamentals did not improve during that crash. Supply did not suddenly surge. Demand did not disappear. Vault stress did not go away. So what changed? Leverage changed. If you have watched commodity markets for long enough, you have seen this movie before. In 1980, COMEX used Silver Rule 7 against the Hunt brothers, forcing liquidation-only trading and effectively full cash margin. In 2011, CME raised silver margins 5 times in 9 days as silver approached $50 and the metal collapsed. Same pattern. Retail money rushes in. Leverage builds, the price spikes, the exchange raises margins. Leveraged longs are forced to sell. The price crashes. And during that crash, stronger hands buy the physical metal at lower prices. That is the argument. In 1980, it was central banks and sovereign buyers. In 2011, it was Asian accumulation that did not show up clearly in ETF data. In 2026, this script argues it is Jane Street, Sprott, Shanghai institutions, and now a major policy shift in India. And here is the line that matters most. The paper market and the physical market are not the same market. They have not been the same for years. But now the gap may be getting too wide to hide. When the world's largest volatility trader increases its position 500-fold in the same quarter that margins are raised, leveraged longs are forced out, prices collapse, and registered inventory drains at historic speed, you are no longer just watching price discovery. You may be watching a managed event, and that changes the question. The question is not simply, why is silver falling? The better question is, who is on the other side of that trade, and what do they see that the market has not priced yet? Now let us be fair. There is a bear case, and ignoring it would be lazy. SLV has seen outflows since the January peak. JP Morgan has published an average silver target around $81 for 2026, below the January high. If the Strait of Hormuz reopens quickly, energy prices could cool and some inflation pressure could ease. Bank of America has argued silver overshot fair value near $60. Solar manufacturers continue reducing silver content per photovoltaic cell, which lowers silver used per unit. And CME's floating percentage-based margin system can amplify volatility in both directions. All of that matters, but none of it changes these larger points. The world has been consuming more silver than it mines for 6 straight years. COMEX registered inventory is down 64% in 6 years. China has placed silver behind an export control wall while importing it at an 8-year high. India has turned physical silver into legal monetary collateral for a banking system serving 1.4 billion people, and Jane Street took a 20.66 million share position while the price was falling. The bear case may explain the paper price. It does not fully explain the physical market, and history suggests that when paper and physical diverge for long enough, physical eventually wins. Not instantly, not smoothly, but eventually. Because at the end of every futures contract, every ETF structure, and every chain of paper promises, there is one hard reality. Someone can ask for metal, and when too many people do that at the same time, the exchange has only a few options. Deliver the metal, settle in cash, or change the rules. In 1980, the rules changed. In 2011, margins were raised. In 2026, margins have already been raised. The next stage, according to this argument, is delivery stress. And delivery stress is not just a theory in this script. It is said to be visible in COMEX vault data, visible in Shanghai inventory declines, visible in Hong Kong premiums, visible in the Sprott capital raise. The only place it is not visible is on the screen price, and that disconnect may be the opportunity. So let us bring it to this moment. Silver is around $72.20. The Strait of Hormuz remains closed. The Fed is not cutting. The Bank of England is not cutting. The ECB is not cutting. Oil is above $100. Inflation is running above policy comfort levels. COMEX registered silver is around 76.4 million ounces. The depletion clock is around 145 days. Jane Street holds 20.66 million shares of SLV. India's silver collateral policy is live. China has imported 790 tons in 2 months while restricting exports. Shanghai inventories have fallen 43% in 1 quarter. The Silver Institute is forecasting a 67 million ounce supply deficit for 2026. Samsung's solid-state battery work with BMW points to potentially much higher silver use than current lithium-ion systems. And BHP has monetized its silver byproduct stream in a $4.3 billion streaming deal, the largest upfront payment ever in that industry. And the price is still $72. So now ask the obvious question. Which of these is wrong? Are the fundamentals wrong, or is the price wrong? Did Jane Street make a massive positioning error, or has the market failed to price what Jane Street already sees? Will India's new policy do nothing, or will it quietly lock away tens of millions of ounces? Is China restricting and importing silver for no strategic reason? Or has Beijing decided that silver now matters far more than the market realizes? Is the COMEX vault drain irrelevant? Or are we moving toward a delivery event, a cash settlement, or a rule change that exposes the gap between paper silver and physical silver? You do not have to guess blindly. You only have to watch what the best informed players are doing, and what they appear to be doing is building physical exposure while the paper price falls. If you have stayed with me this far, you are probably not here by accident. You did not click this because you wanted reassurance that the screen price explains everything. You clicked because you know patterns matter, and here is the fork in the road. If the strait reopens, inflation cools, and central banks gain room to cut, silver may consolidate while the physical market tightens quietly in the background. But if the strait stays closed, inflation stays high, central banks remain trapped, and real rates slide lower, then the gap between paper pricing and physical reality could become impossible to ignore. In the first scenario, there may still be time. In the second scenario, there may not be. And the institutions positioning right now, according to this script, do not look like they are betting on the first outcome. Before we come to an end, I want you to subscribe to Bridgeport Finance channel. If this video connected dots you had not seen connected before, hit like and share it with one person who still believes the screen price tells the full story. Not just for the algorithm, even though it helps, but because when the next viewer scrolls down and sees that phrase again and again, they will understand what this community is about. We do not trade headlines. We watch the vaults, we read the filings, we follow the structure, and we stay until the last word. Silver is $72. Registered inventory is 76.4 million ounces. The depletion clock is 145 days. India's policy is live. China's export wall is up. Jane Street's position is filed. Sprott's capital raise is active. The strait is closed, the Fed is trapped, and someone is buying while the price falls. You already know what that suggests. The only question left is whether you act before the screen price catches up to the vault data or after the opportunity is gone. Invest with data, never with headlines. Thanks for watching.